Morning members, and welcome to this morning's committee meeting on the pension subcommittee and joint board. For remote participants, please follow good practice guidance, which includes muting microphones and switching off your video when you're not addressing the meeting. If you want to speak, please write speak in the Teams chat function when you want to contribute. And if you're in the hall, do this on your iPhone or iPad or stick your hand up. Please don't repeat contributions already made by other members, and no material should be posted in the chat function if it is intended to be part of the discussion. The usual standing orders apply, including that any votes will be undertaken by roll call. And if any member has to leave the meeting, please either indicate this by writing leave in the Teams chat for the time you're away, and if you return, join in order that we can ensure that the meeting is quorate. All members should speak clearly and directly to a microphone when making contributions, and when referring to reports, please provide reference to a relevant page and paragraph to allow everyone to follow. Please focus contributions on areas where clarification is required or proposed an alternative to a recommendation. Moving on to meeting, Tracy, can we have Cedric apologies, please?
Thank you, Chair. I'll give you the Sederent for the Pension Subcommittee first. So we have 6 members present in total, 4 present in person at Council HQ, being the Vice Chair, who will take the role of the Chairman in the Chair's absence, and Councillor Hislop, Councillor Mail and Councillor Thompson. And I had apologies from Councillor Drybra, Councillor Dorward, Councillor Slater and Councillor Wood. And for the Pensions Board, we've got 4 members present in total, 1 present in the chambers, being Andy Ferguson, and 3 present on Teams, being Helen Croney, Colin Graham and Keith Walters. And I've got apology from the Chair of the Board, David Stainthorpe.
Thanks, Tracy. Can we ask if there are any declarations of interest for the Pension Subcommittee, please? Not seen any indication of that. Can I have any declarations of interest for the Pensions Board, please? Again, no further indication. I see in the chat that we've got Gil McGregor saying I'm here too. Was she not included? Yeah. Thanks for that. Moving on to item 5. This report provides members with an update from the Grant Thomson, the Pension Fund external auditors, on the delayed audit of 21-22 financial statements. The final audited version of the accounts and letter of representation will be submitted for members' approval at the next meeting of this subcommittee. Joanne Brown from Grant Thomson is available to provide this update and take any members' questions. Is Joanne there?
Morning, everybody. I'm Jo. I'm the partner for the external audit, and I lead our team in Scotland. What you have in front of you is a short update paper. The key things I would just draw members' attention to is we've recirculated the pension audit plan, which is our external audit plan. That came to the Pensions Committee in March, so we've just recirculated that, recognising a potential change in membership. Our paper notes that we've done a number of planning inquiries where we've got officers' responses. We will share that with the chair of the committee to ensure there's no omissions or anything else as external auditors we should be aware of. There has been a slight change in the timetable as noted in the outline paper. Our pensions work itself is predominantly nearly complete, and there's been no material misstatements or matters arising that I would want to draw the committee's attention to at this stage. We're looking to conclude our work on the financial statements, and there's 2 areas we're still working on, which is investment testing and journals. We're looking to conclude that over the next couple of weeks, and we'll liaise with Karen and the pensions team to conclude our annual report, and we'll bring that to the next committee meeting alongside the final financial statements for the pension fund. I'm happy to pick up any questions that members might have.
Any questions, members? Ian?
Just a quick question, Jo, with regard, are you confident you'll make the timescales, because it's quite getting near to the timeline for us signing it off? And if there's any issues, will we have time to look at them properly before we actually sign off the accounts?
I'm confident in terms of the timeline. We have a work that is 90% complete. These are smaller areas of our work, and any matters that we arise will be pulled together in our full annual report, which we'll present back to this committee in detail, and we can take questions on anything arising there. And that will give members of the committee sufficient time to be assured over the external audit process and the financial statements before they are then signed by council officers. I think the timetable, although there has been that delay, I think the timetable still allows you to meet the statutory deadline, which is the end of November, and then publish the pension fund accounts in accordance with that guidelines.
Then just to add to what Joe's just said there, just to make members aware, we're looking at switching the date for the next planned meeting of this committee and board was due to be the 1st of December, but we're looking to try and bring that into the sort of last week in November to enable us to meet the statutory deadline of the end of November. And obviously we'll get the audit report from Grant Thornton and the annual accounts out with those papers, at least a week or so in advance of that meeting, to allow members the opportunity to review them.
Any other questions from members? Okay, if we go to the recommendations, members are asked to note that the external audit update paper provided at Appendix 1, highlighting that the pension fund audit of 21-22 accounts has been extended due to resourcing challenges at Grant Thornton. Have we not? Thank you. And also note that the external audit report for 21-22 will be brought before the members at this subcommittee in November 2022. Members not? Thank you. Moving on to agenda item 6. Recommendations are members are asked to note the annual report of the local government pension scheme issues and administration activity for financial year 21-22. This report covers the This paper provides an update on the activity carried out by the pensions administration team in financial year 2021-22. And this is an annual report received by a committee. The Stuart Clanakin, Human Resources Manager, is available to take any questions members may have. Stuart, over to you, thanks.
Thank you, Chair. Nothing to really add to the report. Hopefully members see the comprehensive appendix there in terms of the activity. I think it goes to show another productive year for the team and a mix of normal business and development work. We continue to work well through COVID and now into a hybrid working arrangement. And we now see that is proving really helpful for us. We continue to be efficient, both within the office and at home as well. There is some key developments around the computerisation, the digitisation of the service, and we will continue to push the information out to our 17,500 members of the fund. And we do have very, very good contact with our customers, whether it's internal customers or external within the community. It's a valuable service. We provide really helpful information that allows people to plan for their retirement, but happy to take any further questions.
Thank you, Stuart. Any questions from members? Councillor Thompson.
Thanks, Chair. Thanks, Stuart, for the report. It's just at section 3.8 where it's sort of talking about the membership continuing to grow in the last year by 5%. And that includes multiple employments. So obviously we'll have multiple records at times for single individuals, if you like. I was just wondering, in terms of administration at an individual level, is there how do we manage the risk of potential confusion if people are getting multiple statements? Because that sometimes you might want a unified record rather than a number of separate statements, because after all it's the same national insurance number, if you like. So it's just really a wee bit more detail on that. Thank you.
Yeah, no problem at all. Yeah, we record multiple employments within the record system. We make sure that each employment, specific separate employment, has a unique identifier, and that allows us to not only manage the data in the most efficient way, but it also allows individuals to identify which pension record relates to which job. So we continue to do our very best in relation to making that information as clear as possible for members, so that they fully understand what their total pension provision is, taking into account whether it's 2, 3 or sometimes even 4 multiple employments that all come together under the one pension record. Thank you.
Thank you, Stuart. And we've got a question from Phil McCrogan.
Hi, Stuart. Stuart, this is a question basically to see the strength of your team. Like, I'm very conscious of the service that you provide and the team that you have, although I'm not sure there's been changes within it. But when members come asking for advice, and sometimes they get a printout and they do get the annual paper, and then they bring it in here and we try and discuss it and go through it. And then if we ask a question, what comes back necessarily on an email, even for me, is quite difficult to get my head around. So what I'm asking is there an opportunity within your team to set up, where appropriate, a one-to-one situation where the member can sit down with one of your team, go through it in detail so as to give them a really good understanding of their pension and what's there for them, rather than a contact or an email?
Thank you, Phil. Yeah, absolutely. The team are always available for contact, whether it's over the phone or email, but most importantly, that face-to-face contact. We've lost that, as many services did over the previous couple of years. Pensions is a complex area of business. We know that. And what we are always trying to do is, when we test the language, we test the information that we send out. Does it make sense? Is it plain English? Will it be received well? And will people really fully understand their position? Because that allows them to make the best planning decisions. So in terms of that information, we're always challenging ourselves to make it as simple as possible. And that is a difficult process. But for me, in terms of the experience that I have in this particular area of business, nothing beats the conversation and the explanation as to what that information really means. My team are accessible. They will continue to be accessible. I am accessible and happy to speak to anybody at any time if it helps them understand their pension position, because that's for their benefit, and that helps us too as a team. So feel free to refer them across, Phil, and we will be more than happy to meet them face to face and have that direct conversation with them. Thank you.
Appreciate that, Stuart. You'll be hearing from me.
Councillor Ferguson.
Thanks very much, Chair. Morning, Stuart. Just a couple of questions in 3.8. The figures you've given, 6644 up to 6822, how does that equate when we've lost DGHP? Or is that after that? So will that number come down, or is that ex-DGHP? That was the first question. The second one's kind of a personal one. When, again, we're saying there's an increase here. I've got a work pension, as you know, from the council, but I'm also paying into another contribution for a further pension. Is there no way that I can get that amalgamated? I think that was the kind of question you were asked earlier, so that I've got one statement at the end of the year rather than two separate accounts, because that's the way it appears to be just now. Maybe that's a one-to-one job as well, but if you want me to do it that way, I can do it.
In terms of answering the question just about an increase in numbers, we are really fortunate in Dumfries and Galloway. We have a well-informed workforce around the importance of pensions. I think some of that is down to the messages that we send out, the way in which we try and communicate with the workforce around the importance of pensions. So we have compared to other authorities, we have a large success rate of people who value paying their money every month into the pension scheme and getting those valued benefits out at the end of time where they retire. So you know, we're always trying to get the maximum, which is 100% of the workforce, which is not achievable in any way, kind of shape or form anywhere across the UK. But we are always encouraging people to join the pension scheme because it is a good thing to do. They're also one of the areas of legislation that I suppose in a way pushes people into pension schemes and the auto-enrolment rules, where every 3 years people who have opted out of the scheme are automatically put back in. Then they have to opt out again. And that in itself creates additional individuals who will come into the scheme. So I'm optimistic that the numbers that we have are really healthy and really good. For DGHP, they transferred out in March. So that would be the end of March. And this report deals with the members from the 1st of April the previous year to the 31st of March this year. And whilst that might look slightly different next year, the numbers in DGHP were not significant. We would not anticipate a large reduction on the back of the DGHP transfer, and in fact that may well be mitigated throughout this year with new starts coming in and other people who have opted out also coming back into the scheme as well. In terms of just general personal business, happy to talk to you about that at any time in relation to how we can or can't amalgamate pensions together. We do often amalgamate pensions together if the legislation allows it, if the employee or the member desires it, and I'm more than happy to have that conversation with you about your specific circumstances. Thank you.
Thank you, Stuart. Councillor Walters.
Could I just ask you a couple of questions about the metrics report, the pensions trends and analysis, which is page 41 on the agenda. On the admin costs, it says it's gone up from 26 to 35, and it says this is to do with the introduction of iConnect. Can you just tell us how far that is down the road and when you'd expect the admin costs to go down because of the efficiencies of the iConnect being established?
Certainly, thank you, Councillor. So the iConnect is a new piece of software that you have to then buy in and then you maintain it, and you then benefit from the efficiencies in the medium to longer term. And what it will do for us, and it will remove a significant number of manual processes, manual interventions, not only for us, but for the council and for other employers as well. Pensions inherently is a labour-intensive service required, and in the past, moving into the digital age required a lot of manual intervention, manual input, and we're always looking for those opportunities that then makes that simpler, easier, cheaper, and more efficient to do so. And the exchange of information between the council as our main employer of the fund, as well as some of the other smaller employers. This iConnect system will make it so much smoother. It will reduce administration costs at our side, but it will also reduce administration costs within payroll services, not only for the council, but also for outside bodies. So we anticipate that those efficiencies will be evident in the next financial year. We're not fully operational with iConnect yet, but we anticipate by the end of this financial year, we will be fully operational in the iConnect system. Thank you.
Thanks
very much.
Councillor Hislop, please.
It's on metrics as well. The data quality on page 47. There's one or two, I would say, sort of big numbers there. The likes of the 330 addresses incomplete, and some of the other ones on page 48 are into the hundreds of numbers. Are you confident that the actions in place will address this, and is the position we have today better than it was after the last report?
Thank you, Councillor Hislop. Yes, we are in a better position. We are constantly improving the information and the data. These do look like relatively high numbers, but they were significantly higher in the past. There are mechanisms that allows us to address these, and through our tracing services, we can find those gone away. People move without or possibly not remembering that they have a pension record. So it's our job, it's our duty, and the pension regulator requires us to do everything that we possibly can to trace individuals so that we can inform them that they still have a pension record with us. It is a cyclical process, so when records are fixed, new gaps will appear, but it is always an improvement journey, and that's really important to emphasise. And the systems and the processes and the checks and the balances that we have in place are robust, and we will always continue to review those. And if there are new opportunities where we can find people and trace people, and we're using national systems that allow us to do that, then we will absolutely explore that to make sure that we minimise these gaps in information. Thank you.
Thank you, Stuart. Any other questions from members? Okay, no indication in the room, no indication online. If we can go back to recommendations, members are asked to note the annual report, the local government pension scheme issues and administration activity for financial year 2021 to 2022. Can we note? Thank you. Thank you, Stuart. Moving on to agenda item 7. The recommendations, members are asked to scrutinise the proposal for changes to the pension fund investment strategy as detailed in the appendix. Agree the revised asset allocation as detailed at paragraph 3.6 that includes the following actions. Remove the UK equity allocation, increase the alternative income allocation by 4%, remove the emerging market debt allocation and consider a new allocation of 9% to multi-asset credit fund. Consider responsible investment tilted passive funds for global equity and UK corporate bond funds. Monitor for cost-effective opportunities to allocate to residential property, and monitor for opportunities to switch into alternative protection assets. 2.3, note that whilst these changes are being implemented, the fund will continue to hold an overweight position in UK equities. 2.4, note that consideration of the options available for the implementation of this investment strategy, if agreed, will be considered as an exempt item later in this agenda. And 2.5, note that further updates on the progress made on the implementation of the revised investment strategy will be brought to future meetings of this subcommittee and board as required. This report covers the second stage of the investment strategy review. Following the initial high-level decision taken by this committee in December 2021 to reduce the fund's growth seeking assets by 10% to fund an increase in income-generating assets. This report provides proposals for the detailed assets allocation to the fund's growth, income and protection assets. Ian Campbell from Hyman's Robertson is here to take members through a detailed presentation on the review proposals and answer any questions members may have before we move on to the recommendations. Over to you, Ian. Sorry. Yeah, Phil McGrogan, do you want to come back in, please?
I'm happy to wait till Ian has done his presentation and then come in with a question after that.
Yeah, thanks, Phil. If you could indicate again just to prompt us. Thanks. Ian?
Thank you, Chair, and good morning, everyone. Starting on page 55 of the pack, we have a fairly lengthy presentation here on a number of different considerations for the fund's investment strategy. So just as a quick background, back in December of 2021, it was approved to make an alteration to the fund's overall investment strategy from a very high level perspective, where it was agreed that from a long-term perspective, strategic view, that the funds no longer needed to hold quite as much in growth assets as they did in passive. As they did in income, as they currently do. So we agreed that 10% should be moved from growth into income, and that would have benefits of reducing the risk of the investment strategy as well, increasing diversification. It's also worth mentioning that In the March committee, we agreed a set of responsible investment beliefs for the fund, and so now it's right that we should consider how to implement both of these decisions. So we have here a paper from a high level considering how we should be looking at implementing these switches and these beliefs, and then later on in the meeting we have a presentation on some specific decisions around particular funds to implement this through. So as a quick background on page 57 of the pack, this is the fund's current investment strategy before the agreed change to reduce growth assets by 10% and move them into income. So this just sets out how Hyman's looks at investment strategy for a fund like yours. So we classify asset classes into 3 different categories based on the purposes that they serve for a pension fund like yours. So we have growth assets. So they're there to generate long-term returns above inflation, strong returns. And the purpose of that is to improve funding and also to reduce the pressure on contribution rates from employers, because the more return you earn, the less they'll have to pay in. The downside to them is that they tend to be risky and pretty volatile. So typically these tend to be equities, but also within your strategy you also have an allocation to a big diversified growth fund as well. So that sits in your 62% allocation to growth assets. Income assets are there to also generate strong returns, not quite the same level as equities, but do so in a way that's very diversified from your equities. So you're maintaining returns but increasing diversification, reducing overall risk. And also some of these asset classes can pay you returns in the term of actual cash flows that are paid and put in your pocket, which can be very helpful from a perspective of paying members' benefits. And they tend to be lower volatility than the equities as well. And then finally, protection assets, which are meant to be low risk, low return holdings. They're all about kind of protecting your funding level, reducing the risk that a big deficit increases. And particularly they should have low correlation to your other investments, particularly in times of big market stress. So when equity markets are dropping off, you want these types of investments to hold their value or maybe appreciate. And that tends to be what happens when equity markets sell off. Everyone rushes into low risk holdings and you'll see the value increase, and that's therefore going to protect the overall fund value and funding level. So they're the purposes that you invest in these different holdings for. And on page 58, we just set out what's been agreed, and it really just sets out the task. So simply moving 10% of assets from the green, growth assets, into the blue, income assets. And that's all that's been agreed, just that high level perspective. But of course, the question then comes, well, how are we actually going to implement that with actual asset classes, actual investments that we hold or may want to hold? And page 59 just sets out a table with a few different bits of information. So we compare, starting with the right-hand column, that's your agreed target. So we only have the target allocations to growth, income, protection, not the individual asset classes that are listed. The middle column shows you the current target to each of those individual asset classes, but actually the second column in 30th of June, that shows you the asset allocation of the fund as at the 30th of June between these different asset classes. So what this is there to show you is actually, whilst we're saying let's move 10% of assets from growth into income, actually you're already 7.3% overweight your current 62% target to growth, and you're underweight allocation to income and protection. And so that means actually we're going to need to shift about 17% of our assets over time to implement this new agreed investment strategy. So we're now going to look at just a few different ways that we think we should implement this. But I think just on page 60, this is just to point out that when we originally made the recommendation to you of changing your allocations to growth, income, protection, that was focused on the left-hand side of the diagram on page 60, so focusing on the strategy piece. We're now looking at the structure piece. So this is the more detailed bit of, well, in each of these growth, income, protection, what should we be allocating to and how much? So that's the focus of today's presentation. And also, as I mentioned, we set some responsible investment beliefs for the fund. So on page 61, this just provides a summary of the responsible investment beliefs that were agreed. And in summary, The beliefs are that you have an overriding obligation to act in the best interest of the beneficiaries. You have a fiduciary duty to make sure you're able to pay all members' pensions, but you have a belief that responsible investment issues and environmental, social and corporate governance issues, or ESG issues, can positively affect the financial performance of your investment. So it's within your duty to start factoring these in to your investment decision making. I think it's also important to note that you also have a belief that you never want to implement ESG views if it would mean doing so in a way that reduces your financial returns. So you wouldn't be willing to give up returns to do good. You want to start to factor in ESG considerations only where they at least aren't expected to reduce your returns. So that's really been the driver for how we're going to recommend that you start to implement your RI beliefs in your investment strategy. And so page 62 just sets out the agreed areas that we said we would look at when we agreed the overall investment strategy. So this is looking at what parts of the investment structure we agreed to look at. So we said we would need to look at how we're going to reduce the growth holdings, and also what's the makeup of these. It's a great opportunity to look at, well, our funds that we hold within growth assets, is that the right mix? Again, the increase in income assets, we need to decide how we're going to be doing that, what types of funds we should invest in, and then some considerations of the property allocation. How should that look going forward, given the big impact that COVID had on the commercial property market? Options for protection assets, which I'll cover, and also the implementation of RI beliefs across the whole portfolio. And we'll just go through each of these step by step. So starting with the growth portfolio, page 64 of the pack just sets out what the current growth portfolio, how that's currently designed. So vast majority currently in equities, a UK equity fund, 2 global equity funds and a diversified growth fund. So the areas we agreed to consider were how we're going to reduce this allocation, consideration of the big overweight we have to UK stock market in the portfolio, and also how we implement ESG. You'll notice we haven't got any considerations around the diversified growth fund. That's because we believe that that still has a strong place in your growth portfolio, so we don't want to be touching that at the minute. So starting with the UK overweight on page 65. So when you invest in equities, it's kind of the standard now to invest from a global perspective. So the kind of standard global benchmark of equities, it invests in companies from all over the world, and it invests the most money in the largest companies. And based on this, the standard global benchmark would only allocate 4% of your assets to UK listed companies. Because the fund currently holds a large standalone allocation to a UK-only fund, this means that actually the split of your equity portfolio, you actually hold almost 35% of your equities in the UK. So this presents a big potential risk, concentration risk in the UK, whereby your returns are potentially going to be overly driven by the success or lack of success of the UK stock market. And we believe that because this is such a big overweight position, 13 times what it would be if you just followed the standard approach, that actually, unless we have a really, really strong and kind of well-founded, well-researched view, we shouldn't have such a big overweight. We still want to allocate to the UK. We're not saying sell all UK equities. We're just saying let's take that weight down to kind of the market standard so we don't have this big concentration risk there. Page 66 gives an idea of some reasons why. It's quite a busy slide, but starting with the chart on the left, this just shows you what the sector exposures are of the UK stock market in blue versus the global stock market in yellow. And kind of the big story here is the UK stock market, because of the companies that just so happen to be listed on it, has big overweights to energy companies and financial companies, whereas it has almost no exposure to technology companies. Now, this year, in 2022, that's been great because energy companies, financial companies have done great, whereas technology companies have really underperformed because of what's been going on in the global economy. But over the last 10 plus years, that's been a drag on returns. UK's really underperformed global stock markets. And really we have a view that actually that past 10 years is probably going to be more reflective of what's going to happen in the future. And maybe the UK is actually more reflective of kind of the older economy, these old traditional banks, oil and gas companies, whereas global stock markets may be a bit more, better reflection of the future economy and also just better diversified and more well-rounded. And then just giving an idea of some issues around stock concentration of the two different stock markets. So the top of the two right-hand charts shows the weightings of the top 10 holdings in the UK stock market. And we can see in total they add up to almost 45% of the index. So in your UK equity fund you invest in, almost half of your money's invested in 10 companies. Whereas the global fund you invest in, only 15% of your money is invested in the top 10 companies. And similarly, just taking it as an example, the two biggest holdings in the UK stock market, AstraZeneca and Shell, add up to almost 15% of your money, whereas in the global that would be 10 companies, and they're companies like Apple, Microsoft, Google, Amazon. So here we think there's a big concentration risk of being overly exposed to specific companies as well, which isn't very diversified. Now, the big argument back is always, well, if we're investing in the UK stock market, aren't we supporting the UK economy? Because then that's not something we should be doing as a UK local government pension scheme. But the answer is not really. So UK companies or companies listed in the UK on the London Stock Exchange are the biggest ones are generally global companies, huge global companies that just so happen to have listed on the London Stock Exchange because at the time that was particularly attractive to them. So largest holding huge global companies with not that much exposure to the UK. Companies like HSBC, huge global bank, not overly exposed to the UK economy or helping it that much. They have operations all over the world and typically don't have specific loyalty to the UK if they're going to choose where to open particular operations, a factory, a call centre, whatever. They'll typically choose the best financial option for them rather than any loyalty to the UK, so it's not generally going to be creating huge jobs by investing in these companies. And just to drive that home, studies have found that 75% of revenues generated by the biggest 100 UK companies or companies listed on the London Stock Exchange are generated overseas. So the vast majority of their business is being generated overseas. So if we were to sell this big holding in the UK stock market, it wouldn't be a big hit to the UK economy. It wouldn't be us saying we don't support the UK economy. It would be, well, let's invest our money in a more diversified way. And actually, as we'll come on to later, some of this money would be diverted into other types of investments that do a lot more to support the UK economy. But that's to come on to. So the recommendation here is that we think we should sell the UK-only equity allocation that we hold and invest only on a global basis. So this would require selling your Legal and General managed UK equity fund. So from a strategic perspective, this would mean reallocating 6% of the current 16% allocation you have to the UK to global, and then the remaining 10% to income. But actually, from the table I showed you earlier, you wouldn't actually need to sell any of the UK assets to allocate them to global because your weight in global equities is already at this new higher target that we're setting of 42%. So you wouldn't need to actually move any equities from UK into global, which would reduce the transaction costs. Of course, the timing and implementation of this will need to be managed to make sure we do it in a cost-effective way, minimise the pricing risk of selling out at the worst possible time, but also because they'll be moving into income assets. These, depending where you invest, can take time to get your money invested. So that would mean they would just be sold down over time as those investments were found. Once fully implemented, you wouldn't then have no exposure to the UK. You would still have exposure to the UK through your global funds. It would just be less than it is now, and considerably less. And this is just also a neat way of reducing your 10% overweight currently to the growth allocation. So that's the first recommendation regarding the UK. So it's maybe now a good time to pause to see if there's any questions on that or comments.
Any questions from members? Phil, do you want to come in now?
Thanks, Chair. Thanks, Ian. I started off with one question. You've created a whole shed load now. If I'm looking at, based on what you're saying, if I'm looking at page 59, and I'm looking at, you're looking to remove the UK equities of 16%, is that correct?
That's correct, yes.
And then below that, you've got the global equities. You're looking to invest that into the global equities.
Just
Below
6% of that.
Just 6% of that. Yeah. So that increases that 36% then up to the 42 in the left-hand column.
Correct.
Okay. So the 18.1% in the left-hand column for UK equities, how do you get that figure?
That's the current allocation as at the 30th of June that the fund actually holds because you're slightly overweight your target.
Okay, so we're not 16%, we're 18%, and we're going to take 6% off the 18.
No, so from a strategic reallocation perspective, what your benchmark allocation will be, we'll take 6% and allocate that to global to bring that up to 42. We'll take the remaining 10% of the strategic allocation and that will move into income assets. Take that up to 33. In terms of actual implementation of real money, it would be selling the UK equities down over time to move them into the income assets, which would broadly bring the fund in line with its new targets because it's overweight growth assets, about the same amount as you currently hold in the UK.
Okay, my question is that I had originally put down, and please bear with me because the pensions and how they're discussed it might sound daft when I start asking these questions, but later on in these reports, because these percentages don't speak pounds, shillings and pence, but later on in these reports, there's a recommendation going to the committee that we would issue 75 million to BlackRock, and there's not really a lot of basis for giving that 75 million to BlackRock, considering that in the report itself it says there's no data from BlackRock with regards to it. So my question is, would that 75 million be better used elsewhere, considering that we're looking now to invest in these multi-asset credit?
No, we believe that the 75 million would be best invested with the BlackRock fund. It wouldn't be taking money away from the multi-asset credit allocation. We believe that we should make a allocation to that of 9%. We think that's the right amount for the fund. So no, we believe that this is the right recommendation for the fund to implement.
So forgive me, Chair. So do I continue on this line of questioning for this report, or do I wait till we get to that report and then I'll question you on it again?
Yeah, Phil, I think that's somewhere later on our agenda, so if you could come back in later if you have any further questions. Councillor Thompson?
Yes, thanks, Chair. If that's okay, I'm just conscious that we could end up getting into sort of details that are actually in an exempt paper, so it's maybe best to just park that one there just now, because we're not taking any decisions yet. But I think it was on page 65, and I think part of your preamble was really about, I suppose, backing Britain or something like that. But ultimately, our fiduciary duty is actually just to have the proper governance of the fund and make sure we're invested at the right level of risk to generate the right level of returns to meet our liabilities. And I think that's really what our focus should be, rather than any sort of sentiment. And I think it touches on that on page 65 when it talks about the hangover of a sort of previous assumptions about having to invest in the UK because we couldn't invest elsewhere, for example. So quite comfortable with that. And I think that if the potential or the suggested recommendation is to move towards the multi-asset class at 9% and divest of the UK only element, so that it's just part of the global equity weight, that there seems to be a rationale to that, especially if what I'm picking up is correct, that the exposure to risk and volatility in the multi-asset class and the potential returns across the various strands of what might be included in that is actually less risky than the overexposure to the UK market, which in turn will be less risky than wacky junk bonds, I think, but you know, so we're better off in a sense of managing that risk over the longer term is what seems to be the message, just taking the sentiment out of it really. So reasonably comfortable with that. I just want to ask a question on the table. So it talks about the emerging market bonds shrinking down to zero, but presumably part of the products which would include emerging market bonds might then be subsumed within the wider multi-asset class. Is that correct?
Yes, that's correct. We have a little section on that later in the paper, but yeah, we think it's right that if we're going to be investing in multi-asset credit, that has an element of emerging market debt in it. So it's correct that we should take the current standalone allocation, move that into multi-asset credit, rather than have double up on that exposure.
Okay, thank you.
Okay, thank you.
Any other questions from members? No, thanks, Ian. Have you got to carry on?
Okay, thank you. And then just the final piece on the growth allocation here is, so we have these RI beliefs, and we believe we should be starting to implement them in the investment strategy. This key belief that we believe ESG implementation is good for returns, but there are ways that we can do it that might not be good for returns, and we don't want to do that. So we think a great way to start implementing our RI beliefs in line with those is to consider moving the passive global equity and the UK corporate bond holdings into responsible investment or ESG tilted versions of those funds. And we have information in a later paper on exactly what they are. So it's not for agreement in this paper, it's in the next paper, but just to note that we believe that this is a great place to start to implement some of our RI beliefs in a way that isn't expected to have any negative financial returns for the fund. But that will be coming up in a later presentation. So that's all I had on the growth assets. Looking at the income portfolio, starting on page 71. So again, we have set out what you currently hold with 3 property funds, allocation to the BlackRock Strategic Alternative Income Fund and the Emerging Market Government Bond Fund. So considerations we need to think of is how we're going to increase the allocation by 10%. Should we start looking at further what we call alternative income assets, which is what you currently have exposure to through the BlackRock Fund. Diversification of what we've called higher risk bond holdings, so that is your emerging market government bond funds, your emerging market debt holdings, how do we diversify that better, and also some future considerations for how we want to alter the property portfolio in the future. Just starting on page 72 of the pack. The funds currently invest in alternative income assets with the BlackRock Safe Fund. So these include lots of different asset classes, which I won't go into, but things like property, both equity and debt, infrastructure, both equity and debt, and also private credit, which is making loans to private companies, which are a great set of different asset classes that you don't have exposure to elsewhere in your portfolio, and they have some really attractive attributes at the minute in current markets, which again we'll go into in the later paper. These provide great diversification opportunities for the fund. General LGPS funds have been moving significantly in recent years into these types of private markets assets. So we think that it's good also for the fund to do, and this will be beneficial for investment strategy. So we believe that you should continue to increase your allocation to these types of investments, and a specific recommendation on where to invest that will come in a later paper. But we believe the current allocation is currently 8% of fund assets. We think it can be increased to 12%, and that would be a a good increase for the fund to make. Diversification of your high-risk bond holdings, page 73. So we had an earlier training session on multi-asset credit. Won't go through all of that again, but we believe that rather than investing just in one type of high-risk bond in your emerging market debt only funds that you have, actually you should diversify into a broader range of these types of high-risk bonds to give better diversification, better risk management, while still maintaining good level of returns on these types of investments. And therefore, we believe that a multi-asset credit fund would be an attractive and low governance way to do this. So we believe that the fund should make an allocation of, or a strategic allocation to a multi-asset credit of 9%, which will absorb the current 3% strategic allocation to emerging market debt. And then at a later date, we would then consider how we would implement that in terms of picking an actual fund to invest in. Then regarding the property allocation, so this is one that we discussed at the time of the strategic review and the results of that, that currently you invest 12% of, well, target 12% of your money in property, 3 different funds, 4% each. Property had a torrid time in COVID, particularly retail and offices, which were really hard hit by the lockdowns. It pointed out maybe there was opportunities here to start to diversify your property holding into some different places, that ones that are a bit less overly exposed to the general economy and ones that are a bit safer. And one area that we believe would be beneficial is residential property. This is something that general LGPS funds have been moving into in recent couple of years quite significantly, and it really held strong during the pandemic because people always need homes. Now, what we don't want to do is sell down any of your current property holdings and move them into a new property fund, because that can be really expensive to do, both the selling and the buying. I'm sure anyone who's bought and sold a house knows how expensive that can be on all the fees and taxes and transaction costs. So what we think we should do instead is monitor for opportunities to just create a new allocation to a residential property fund in the future. So when we considered this back in December, because of the negative returns of your property funds, you were well underweight to your 12% target. So we thought there's a great opportunity here to just let's slot in into that 3% underweight you had, a residential property fund. Since then, as Jane will say later in the performance report, property's had incredible returns. It's done really well and your funds have performed really well. So they are less underweight than they were, so there's less of opportunity here to implement that. But we're starting to see the property market come off again a little bit. So in future, if there is an opportunity and property becomes more underweight, we think it would be great to start to look at some residential property funds to fill any gap there. And that would be a very cost-effective way of trying to do that. So we're just going to keep monitoring for opportunities, and we may bring that to you in the future, depending how returns play out. So that's all I had on the income section. I realised I've rattled through a bit of those, so I can pause there if there's any questions on the specific recommendations on the income portfolio.
Members have any questions? No, you appear to have answered everything. Thank you.
Okay, thank you. So finally, the protection assets. So I said before that these are there to protect the fund by investing in low risk, low volatility assets, protect funding level, and that will perform well when equity markets sell off. Currently, you invest in UK corporate bonds and UK index-linked gilts in this. Now, when we did the strategy review back in December, the yields that you achieve from these type of safe assets were extremely low. And actually, they were being really volatile as well. So we're saying, one, they're causing a huge drag on returns for the rest of your portfolio. And two, they're very volatile, so are they actually protecting against anything? Are they safe? And we viewed at Hyman's, from a tactical view, we viewed both those asset classes as unattractive. Now, what we've seen so far this year is actually these assets have become a lot cheaper. They've lost a lot of value. The yields have risen significantly. So year-to-date gilts have fallen between 20 and 30%. but it means because the price has fallen, actually the yields they're offering you are a lot higher now. So actually, we think they're probably a lot better suited to the portfolio than they were a few months ago. So whilst back then our recommendation would have been to let's sell these or at least reduce our allocations to these assets and look for alternative types of protection assets that we could invest in, the recommendation is now let's not do it now. It's not as urgent as it was because these now look closer to fairer value. But if yields do fall back down to unattractive levels again, we'll keep monitoring them, checking for this, and if they do, then we'll be coming to you saying, let's look at some alternative types of investments we can hold in here. But right now, given we've got a priority of other in parts of this investment strategy to look at, we're not saying there's any recommendation to change them here today. So that's all I had to say on the protection assets. So unless there are any questions on that, I can provide a summary of our recommendations on page 79, where I've completed the empty cells of that table that I started with. And this reflects all of the changes that I've mentioned throughout this presentation. So we can see the UK equity allocation moving down to 0, with 6% being reallocated to global. And as you can see, actually, global's already at 42, so no need to move money between them. UK property, we think, stay at 12% target, but let's try and top that up when opportunities arise with a residential fund. Alternative income assets increase from 8% to 12%. Let's remove the emerging market debt holding and invest it instead with 9% allocation to multi-asset credit fund. And then all those moves will fund the 10% increase to income assets. And then no changes to the protection assets. And page 80 of the pack just sets out the timeframes for when these should be considered. So we had the original strategic asset allocation review where we agreed to reduce the equity allocation by 10% of the fund assets back in December. So that's the top row. For consideration at today's meeting, we have the removal of the UK only equity allocation, which has been recommended in this item. In my next presentation later on in the meeting, I've considerations of how we could implement our RI views by switching the global passive fund of the equities and the UK corporate bond fund into RI tilted versions, and also how we would implement that increase to alternative income assets. So there's recommendations later on those specific items. In December, we'll look at more detail on how to allocate to a multi-asset credit fund, that 9% target. And then next year, we'll start to look at opportunities to invest in a residential property fund and monitor those protection assets and if they become unattractive again. So that's all I had on that presentation. So I kind of pause for final questions there.
Thank you, Ian. Councillor Thompson.
Yeah, thanks again, Chair. So I think maybe there's sort of serendipitous timing, but at 3.8 in the report it does talk about the other aspect of business, which is the transfer of DGHP membership to the Strathclyde Pension Fund, and obviously the sum there can be assisted by that drawdown from the Legal and General UK Equity Fund anyway, so it's sort of, that's efficient, I suppose, in that sense as well. So I take it that would just happen in due course as we start should we agree this, as we sort of start the wheels moving, as it were.
Yeah, we expect the DGHP transfer. We're still waiting on the actuaries to confirm a date. Initially, we were hoping it would be the end of September, but I think the indication now is they prefer to do it at the end of a quarter, so I think it'll be the end of December when that transfer takes place. But obviously, we'll update committee when that has happened.
Members, are there any other questions? Do you have a follow-on for that, Ian?
No, nothing further from me on that presentation, thank you.
Thank you. That being the case, if we go to recommendations. Members are asked to scrutinise the proposal for changes to pension fund investment strategy as detailed in the appendix.
Point of order, Chair. 2.2, the board don't have asset allocation in their delegations, So we should just be noting it, or it's the subcommittee should be agreeing it?
Yeah, that's correct, Chair. In the minute, it'll state that the board has noted the decision of the subcommittee.
Yeah, thanks, because we've not got a predetermined position on it, so we couldn't have voted it even if we were allowed to. Yeah, thank you.
Yeah, thanks, Councillor. 2.2. Agree the revised asset allocations detailed at paragraph 3.6. That includes the following actions. Remove the UK equity allocation. Increase the alternative income allocation by 4%. Remove the emerging market debt allocation and consider a new allocation of 9% to a multi-asset credit fund. Consider responsible investment tilted passive funds for global equity and UK corporate bond fund. Monitor for cost-effective opportunities to allocate to residential property. And monitor for opportunities to switch to alternative protection assets. Do we agree? Thank you. 2.3. Note that whilst these changes are being implemented, the fund will continue to hold an overweight position in UK equities. Noted. Thank you. 2.4. Note that consideration of the options available for the implementation of this investment strategy, if agreed, will be considered as an exempt item later in this agenda. Noted. Noted. Thanks. And finally, 2.5, that note that further updates on the progress made in the implementation of the revised investment strategy will be brought to future meetings of the subcommittee and board as required. Noted. Noted, thank you. We'll move on to the next agenda item. Agenda item 8. This is the annual training plan, and members are asked to note 2.1, the updated record of training and training plan for 2022 to 23, as in the appendix, which will be subject to monitoring at subsequent meetings of this subcommittee and board. And 2.2, that all new members of this subcommittee and board are required to complete the pensions regulator training within 3 months of joining a subcommittee or board, as detailed at paragraph 310. This is a standing agenda item on this committee, and with an update on the training plan. Members have already been informed of 2 upcoming training events to be held in person in Edinburgh. Members are encouraged to attend these events and should let Ross know of their availability to attend as soon as possible, so that relevant bookings can be made. All members are reminded of the requirement to complete the pension regulator training. I'll now open the floor to any questions and comments that members might have. Councillor Thompson.
Thanks, Chair. Yeah, just on the appendix, where it sort of sets out the table of members and the sort of dates and opportunities. So presumably this will be the opportunity for all members of the subcommittee to go through. I presume a lot of people maybe have already started stuff and it's just been not marked off as complete yet, but it will be in due course, and it's just to ensure that the table's up to date, and this is just an ongoing reflection of that. Thank you.
Yeah, I mean, this table will be up to date as of the date that the papers were published. Obviously, we had a couple of training sessions last week that have still to be updated, but obviously the table will be presented again at the next committee. that will include all the training last week and the training that was held this morning. So it is just a point in time, so that will be a couple of weeks out of date now. But and just to remind members, if there's any, like particularly the pensions regulator training, just to ensure that you let us know that you have completed that training, so we can get the record updated.
Yeah, thanks, Karen. Any other members got any questions? Councillor Walters.
Yeah, I emailed about the table on page 92. I'm not sure I emailed the right person, but as far as my records are, I was at both the June meetings, and I don't seem to be on the pension board. So I don't know if who should I follow up with Karen or with Ross?
Yeah,
Look at page 92.
Yeah, if you pick that up with Ross, or I'll ask Ross to get in touch with you later on this afternoon, and we can make sure that that's up to date.
Okay, thanks very much.
If there are no other questions. Okay, thank you. Move on to item 9. Any other business deemed urgent by the Chair due to need for a decision? No items have been brought to my attention, therefore we will conclude that item and move on to item 10. Local Government Review Act of 1973. This is to consider the application of resolution to exclude the public from the meeting in terms of section 50A, brackets 4, and paragraph 6 of part 1 of schedule 7A of the Local Government Scotland Act 1973.
There's an additional meeting in your calendars for the exempt part, so if members could leave this meeting and join the exempt one, please.
Yeah, can members agree to that? Thanks. Thank you.